Thank you. Vice Chairman Barr, the independent GAO report concluded that the Federal Reserve identified risks and took supervisory actions, but did not adequately escalate actions prior to SVB's failure. Do you agree with that conclusion?
Yes, that's the same conclusion we reached in our own report.
Yeah, you did, and I appreciate that, and I've got your report here, and on page 8 of that report, you pointed out that SVB moved from the RBO portfolio, regional bank portfolio, to the large bank portfolio in February of 2021, approximately 2 years before Silicon Valley Bank failed. You also noted on the same page of your report that the Fed board provided the Federal Reserve of San Francisco team, the supervisors here, a waiver to delay the initial set of ratings under the large financial institution rating system by 6 months to August 2022. I think the reason why both reports are concluding that the Fed failed to adequately escalate is because the Fed itself is delaying implementation of the enhanced supervisory standards. So I don't think this is a failure of regulation. I think both reports are acknowledging that it's not regulation, that the bank was subject to enhanced regulation 2 years before the bank failed. So I do want to revisit the issue of the policy recommendations of more regulation, but I also want to ask why the report, your report, says nothing that I can see about monetary policy mistakes. Do you acknowledge that the Fed was wrong in 2021 to conclude that rapidly rising inflation was transitory?
The report is focused on the supervisory failings of the Federal Reserve.
Sure, I know that.
But staff is not.
No, wait, I know that. But do you acknowledge that the Fed should have started to normalize a monetary policy and raise interest rates earlier in light of excess fiscal stimulus and persistently high inflation?
I was not on the Federal Reserve Board at the time.
I know you weren't. But I want to know why the report doesn't talk about this. The divorcing of monetary policy from supervision is a problem. Do you acknowledge that interest rate management would be easier and supervision of these institutions would have been easier had monetary policy tightening started earlier and had been implemented gradually as opposed to precipitously?
The responsibility of bank management is to take the monetary policy, the interest rate world around it, and to respond with appropriate risk metrics.
I understand that, but here's the problem. The argument for why regulation and monetary policy are both at the Fed is that it's supposed to inform each other. Supervisory policy should inform monetary policy, and the reason why the Fed has always argued that we should retain our supervisory authority is because it informs monetary policy. They're intertwined, and the failure of the Fed to acknowledge that monetary policy errors are the underlying cause of bank instability is very revealing. Let me quickly ask you on capital review, two scenarios, Vice Chair Barr. Bank 1 has 94% uninsured deposit. It reports $91 billion held to maturity securities with a market value of $76 billion and an unrecognized loss of $15 billion. Its cash held at the Fed represents approximately 5% of its uninsured deposits, and a single industry represents more than 50% of the institution's customer base. That's institution 1. Bank number 2 has just 14% of its deposits uninsured. It holds 0 held to maturity securities. Approximately 93% of its liquidity is in cash held at the Fed, and that cash represents more than 100% of its uninsured deposits. The bank has a large and diverse customer base with tens of millions of individual customers and individual and small business customers. Do you understand the differences between the banks I just described?
I think in general terms, although of course I was not following your math with precision.
Well, you generally understand the vast difference between those institutions, but they're the same size, exact same size. Do you believe these two institutions should be subject to identical bank capital regime? To an identical bank capital regime?
I think our capital regime should take, and our liquidity regime should take account of the risk profile of the firm.
That's good, because the Basel Committee on Banking Supervision does not. And so my question to you is, will you commit to deviating from the Basel recommendation that fails to tailor the capital charges for operational risk?
I'd be happy to follow up with you to discuss your concerns in greater detail.
Well, I'd like to do that because operational risk differences should inform bank capital regulatory changes.
Gentleman, time has expired. The gentleman from Illinois, Mr. Foster, is recognized.
Thank you. Acting Controller Sue, you emphasized the importance of regulatory discretion in your remarks, which is a lot of what we're wrestling with right here. And there's obviously a fine line between, regulatory discretion and, regulatory capture, which is one of the risks. And discretion, we're learning,